Hello and welcome back to Unitrader. We are continuing our deep dive into the rabbit hole that is market structure, brought to you by Trading Academy. This is part two, where we will go into fair value gaps with a brief pit stop before we begin. A quick disclaimer, this is not financial advice, nor am I a financial advisor. And remember that this is inherently risky, so educate before you participate. Paper trading only. Let's get into it. So before we get into fair value gaps, we're just going to quickly talk about premium discount zones because we're going to try to tie this all together as we go along with market structure. So as we're hitting the charts today, we're going to be looking at how to use fair value gaps in market structure, and we need to know about premium discount zones, which is very basic. Premium zones are found above 50% level or equilibrium of a high and low. All right, so that is a premium zone where you'd be looking to sell, and discount zones are found below the 50% level of a high and a low. Could be either a swing or an internal, doesn't really matter. And we'll get into that on the charts, so it will make a bunch of sense. So moving on to fair value gaps. Now, fair value gaps are a very basic topic. However, it's very difficult to find a good definition. There's a ton of them. So we're just going to use a very basic one, which is a fair value gap is a zone on the chart where the price moves easily due to an imbalance between supply and demand. And they're also known as price value gaps. All right, so generally you'll hear fair value gaps, but they will sometimes be called price value gaps. So if you hear that, you know what people are talking about. More simply, they are a three-bar price action pattern that represent imbalance. All right, we'll get into it. And there are four types of them. We've got runaway gaps, breakaway gaps, common gaps, and exhaustion gaps. Now, for our sake, we will look at all four of them on the charts, but what we're really concerned with here is just the common type of gaps and runaways, but we will talk about the other ones, all right? So what happens is you have a move up, then you get your second candle here, continues up, and then the third candle. All right, so here's your three-bar pattern, and in the middle, you have this gap here where price of the first candle did not trade into and price of the third candle did not trade into. So you mark the low of the third candle and the high of the first candle, and that creates a gap known as a fair value gap. And in this case, as price is moving up, it's our bullish fair value gap. On the flip side, again here we've got price moving down, a three candle pattern. You get a low followed by a move down, followed by another move down, which leaves this little gap here between the high of the third candle and the low of the first candle. And this, my friends, is your bearish fair value gap. So they're very basic three-bar patterns, very simple to mark out. Practice looking for them on the chart, mark them out, and happy charting. All right. So what we're going to think about here is that not all fair value gaps are created equally. We've obviously got four types of gaps normally, but we're interested in the good fair value gaps. All right. So in this case, we're looking at a three-bar pattern here, which is going to leave a fair value gap. And this fair value gap, because the candles are just continuing up and you have a very little wick down here and push away, this is potentially a breakaway gap. Okay, now breakaway gaps and runaway gaps, they look very similar on smaller time frames. On higher time frames, you're generally going to see a much different sort of reality, which we will get into on the charts. But this is a very good fair value gap that we would like to see, but it's usually not going to get traded into relatively quickly. Hence the name breakaway gaps. All right. So when you see a big powerful move followed by another powerful candle, uh, you might see that the next three candle pattern also leaves a fair value gap here. And in that case, this is pretty much confirmed a breakaway gap. All right. The next one is going to be a common gap. Okay, so what happens here is price pushes away. You have a nice bullish candle, and then you have a bearish candle that comes back not too deep into the second candle, and it consolidates slightly before then price continues to move away. And this is called a common gap. All right, so these common gaps are very helpful for us. They often get traded into very quickly. So within the next few candles, sometimes even the next candle will trade into it and then continue on its merry way up. The third candle, or third fair value gap type, sorry, that we're going to be looking at is also a common gap. All right, but we are not going to be very excited about these because we're going to call them the bad gaps. All right, so nobody calls these bad gaps. It's a common gap. But what happens here is we again have a very nice move to the upside, a big bullish candle, and then the next candle retraces quite deeply into the second candle of our 3-bar pattern. So if we get a retracement on the next candle that retraces deeper than 50% of the second candle and leaves a small fair value gap here, we're going to be very cautious with these. They will play out, but they also won't play out. So they're not something that you just stay away from totally. If you can find confluence there, for example, an EMA or something, look to exploit them still, but be more cautious of these. So really, these are good, but oftentimes it'll take a while for price to come back to them. And these are the ones, the common gaps here that have a slight pullback. This could be a bullish candle even, but you want to see a wick come into it relatively nicely and not really push away too far from the second candle, all right? And these usually will get traded into relatively quickly. All right, so having said that, let's hit the charts and see how we can start to bring all of this together. Okay, so on the NASDAQ E-mini futures on the daily chart, we're just going to quickly go over the premium discount theory, all right, which is quite simple. You have an obvious swing low and a swing high here. For swing trades, you're going to be placing your template here, a Fibonacci with a simple 0.5, and you're looking for trades when it gets into the discount zone, so below the 0.5 or below equilibrium. Now, some asset classes don't like going all the way down there, so take this with a grain of salt. All right, on strong moves to the upside, you're going to get retracements that aren't going to go all the way to the 0.5. Your pullbacks will be a little less or a lot more shallow, shall I say. But that is the general gist of it. Okay, but you can see here we break away from this consolidation here, this downtrend, this corrective phase, and then you get a internal low and an internal high. All right, if you haven't seen the first market structure video, go watch it. And you can see that price comes down to our premium zones. And imagine that there's a fair value gap right there. So that's about as nice as it gets. All right. So you can do these all the way up. You've got an internal low here and an internal high. All right. Again, it doesn't come down, but we also have a fair value gap here. All right. Even on the big pullback, it doesn't even come all the way down there. But if you put it from this low to this high, then it does come down. All right. So again, some asset classes, you've got to be really weary about them, okay? So that's pretty much how we use our premium discount zones. So again, you do them from the swing low to the swing high, or the swing high to the swing low, depending on market structure. In this case, we're in bullish market structure, so we're going to take it from the low to the high. And then once price gets into this zone, we can be comfortably, I should say, looking for long positions. All right. And then as we're moving up, we're going to be, we're creating now bullish market structure to the upside. We break this, we put in a low. You can look for a high to then see if we get a pullback. In this case, again, it doesn't, but we'll see in different asset classes that it works much better. So getting into the fair value gaps. Now, what we were talking about on the slides, it's going to look a little bit different here until we get into Bitcoin and the lower time frames, all right? But Tesla here is a fantastic example on the daily chart of all of our different types of gaps, all right? So as Tesla only trades during the New York session on the NASDAQ, all right, it is going to have these big gaping holes here, all right? So when we were looking at this on the slides, we were talking about 3-bar patterns, okay? But in this case, it's a 2-bar pattern. So we can imagine that there is a candle here that just went from where it closed to where it opened, all right? So whatever asset class you're trading that has closes and trades over the pre-market session and overnight sessions, you're going to get these gaps. And that's what these gaps really refer to in the first place, but we're going to use them a little bit differently, all right? So we can see here, obviously, all of these different gaps from one day's close to the next day's open, all right? So let's formulate how these work out, okay? So we put in a high here and we put in a low, and we are ranging in this zone here, and price gaps up here, all right, on the close. So this is not a great example, but we'll find much better ones for Tesla. We can actually use this one. Okay, this is a typical exhaustion gap. So prices are putting in all these gaps to the downside, and then you get this little 2 days of bullish movement, and then you get this huge gap up from this high to this low, all right? So this is the bears becoming exhausted, and this is what an exhaustion candle looks like. And then we had this zone here of consolidation, okay, that we've now gapped and broken back into. And then you get this big gap here, which breaks out of this consolidation zone. So this is what you call a breakaway gap. All right, some refer to a breakout gap, but it's a breakaway gap. Here's your exhaustion gap. This is a common gap, okay, because it hasn't done anything. It's just gapped down, but you're still inside of this little range here, and you've come down and filled in this old gap pretty much. And then we've got our runaway gaps here, okay? So again, we break out of this zone. All right, we break out, and then price gaps up, and then the next day it just keeps running. So this is a runaway gap here. All right, so the best way to mark these out is from the actual close to the wick. Okay, so the close of the previous days, if this was closed red, you would have to put it down at the bottom, and that is going to be the gap. So you'll often hear people talk about the CME gap in Bitcoin. This is what they're talking about, is these gaps, okay? And these are traditionally the gaps that you would call your breakaway, your runaway, your common, and your exhaustion, all right? So again, here we have a nice exhaustion gap, all right? Tesla comes up into the highs, puts in a little range here, and this is an exhaustion gap. And you could actually classify this as both because you've got a range here that we've broken out of, so it's a breakaway gap, and it's also the high of a move where the bulls are just exhausted and price gaps to the downside and then comes back into it and continues to trade away. All right, so a little bit different looking, but we're gonna use more the sort of theory that we're looking at in the slides, not necessarily these big gaps, all right? And you'll see why in a second. On Bitcoin, we have a 24-hour traded asset class, right? So this instrument has no closes. But if we look at the futures market of Bitcoin, all right, so this is the Bitcoin CME futures, again on the 1-day chart, you'll see that there are gaps. All right, so these are the CME gaps that are often filled. You'll hear people talking about these. So for example, you've got a big gap here. All right, you're going to take it from the close of the previous day to the wick of the open of the next day, all right? And you can see price comes back in, fills in the gap perfectly, and then continues to trade downwards. So this is a common gap. This is also a common gap here. So you will see these on Bitcoin if you're looking at the futures chart, but not on most exchanges. All right, but what we're going to look at is these sort of patterns here, where you can clearly identify that we've consolidated here. All right, so this is a small consolidation zone. And then price breaks away from this zone, creating a breakaway gap. All right, so this is a fair value gap on a 3-bar pattern, and it's broken out of a consolidation, so it's a breakaway gap. And then the next candle continues gapping. So this is now called a runaway gap. And then the next one puts in another gap, a continued runaway gap here. And then finally, price comes back into it. So now you start asking yourself, which gap are we going to be looking at here? Well, there's a couple ways to play this. We can start to pull our zones here, our premium discount zones. And these you can actually think about in a couple of different ways as well, because this is a high and a low, a high and a low, a high and a low. So we can look at this from the swing structure, but we can also start looking at our Fibonacci, our premium discount zones a little bit differently, and maybe think about them from where price gets very explosive. All right, and that gap is created. So any of these really are decent places to be looking for a potential buy. All right, and if we look into the future, they all work out very, very well. The first one gets hit really quickly, right? I'm just going to look back here to see, make sure it didn't really accomplish much. No, it didn't. So the first one a few days later comes back in, hits, and continues. And then this zone, many people will ask, how long do you leave the fair value gaps on for? You can leave them on for as long as you wish. I generally will leave them on for some time, and they oftentimes will turn into support and resistance zones. All right, so I might change the color of my boxes, because for me, I always use these purple colored boxes for fair value gaps. These are support and resistance or supply and demand zone colors, so I know exactly what I'm looking on my chart. So price then meanders its way on down, hits the second one, and again, pushes away, and we're still catching these longs in our discount zones, right? And then again comes down into the third one and moves away. All right. So you've got two types of gaps there. We've got our breakaway gap because we broke out of this consolidation, and then you've got two runaway gaps, and they all work out quite nicely. All right, another common gap here. It hasn't really done much. We've got a downwards looking move, and then you get a common gap. Price comes back in. Oh. And you don't get a great move off of that. And that's just the way it goes sometimes. All right, nothing is 100% in this. Okay, so that is Bitcoin futures. And then on the actual Bitcoin map here, we are again trading 24/7. So you're not going to get those same sort of gaps. And we're going to use just our 3-bar patterns here. Okay, so if we're looking for an exhaustion gap, it's going to look something like this. Okay, we've got a bearish market structure coming down. We've taken out some lows here. We play into this fair value gap here, and then price rips to the upside. So this would be an exhaustion candle to the upside, leaving this fair value gap. And now we're looking for good reasons to get into trades in this fair value gap, all right? And we're obviously in discounted zones here because we've come down so far, so there's really no need to pull a fib level here. All right, so this is a perfect example here of how things work and then don't work. All right, very common here that we come into the fair value gap. You definitely get a nice reaction. It is a pretty decent move. But now I would suggest to you that if market structure is telling us that we're putting in lower lows, lower highs, and we're coming back down, would you be looking to long? It's not the best idea, right? Best idea would be being patient and waiting for the pullbacks and looking for the shorts. All right, so let's take a peek at the NASDAQ here, and we're going to think about this sort of from the inside out. So let's look at it on the 1 hour time frame here, and we'll see if we can find any good examples here of what's going on. So this is very nice here. You've got a very strong move here. All right, this is incredibly common. You get a very clean move down, and by clean I mean we're not leaving any fair value gaps here. It's just slowly coming down, and then all of a sudden it gets very aggressive to the downside, and it leaves one fair value gap and two fair value gaps. All right, so this we would call a bit of a runaway fair value gap, and I say a bit because of the first candle's wick all the way down. And then this fair value gap would be also a runaway fair value gap. All right, you could consider it a breakaway fair value gap because it takes out this low here. But now if we look out, we are in very discounted prices here. So it's not something that we'd really be considering looking to exploit the movement of this, right? In terms of FOMO. All right. So this is a very good way to sort of watch what the market is doing. These are the kinds of candles that'll get people really, really excited about shorting or selling. And they're really the worst sort of things to sell because you're down in a zone here with a big fair value gap right back here. Okay, price comes in, hits the fair value gap, and moves away. All right, so if we're looking at these fair value gaps on the 1 hour time frame, we know that this is here. We have another one right here. And that's going to do it for our fair value gaps. So which one is going to hit? We know you don't know. Nobody knows. If anybody tells you they know, they don't. So we don't know which one is going to hit. So what we're going to do is we're going to take this down to a lower time frame, maybe the 15-minute, maybe the 5-minute, and we're going to look at reactions and see if we can come up with a good play here to get on in. Okay. So these are the bearish ones. I'm going to take these off of the table for now. Okay, so price really strongly pushes in. Okay, and that's the first signal you want. You don't want price slowly meandering into a fair value gap or any real level. You want to see some aggression, because when you see aggression coming into levels, it means that people are going to get trapped here. All right, and they're going to then provide some liquidity to the upside. So as people open positions here and put their stops just above their open, once price starts coming back and starts stopping them out, these sells orders are going to turn into buy orders, and they're going to help fuel this move to the upside. Hope that makes sense. Let me get rid of this and this. So this is our 0.5 marker here. So we know that we're in a discounted zone here. Price hits and pushes away, and then miraculously it leaves a fair value gap here inside the fair value gap, but now on a lower time frame. So here's your 5-minute fair value gap, and it is a very nice fair value gap with a nice little retracement back in, and the price doesn't move away too quickly. So it's not like a breakaway looking gap. So this is a very nice common gap that you would assume price is going to come back into relatively quickly. Sometimes it's the first candle, sometimes it's 3 or 4 candles later, but in this case it comes in right away. And now instead of looking at this huge fair value gap, we've got a much smaller zone here to be looking to buy, all right? So you wait for it to come in. There's a couple of ways that people will trade these. The hardcore fair value gap guys will just open a position either right at the entry, in the middle of it, or at the bottom of it, or they will ladder in. So let's say they wanted to open up 3 contracts here or buy 3 contracts. They would buy one at the top of the gap, one at the bottom, middle of the gap, and one at the bottom. In this case, you would get 2 of them filled, I believe. Again, I keep doing that. Again, we'll pull a little fib, all right, in the fair value gap, and there you see the 0.5. So you would have gotten 2 of your orders filled and not the third one. Okay, and then price is going to start moving away from us, and we have to determine where we're looking to take profits, all right? So this is a interesting little zone here. You've got a little pullback candle. I know this doesn't look like much of a move, but it's quite huge. Okay, let's say you hopped in right at the beginning of the move. That's 41 points. If you can hit 41 points in half an hour, you know, that's very nice. This would definitely be a level that you might be interested in your take profit to, or you could be looking to swing trade this all the way up to these highs here. So once you take your take profit 1, you could be looking to potentially shore up your stop loss slightly. You don't want to put it into profit just yet because price has not moved that far away. And then once price starts moving nicely away from it, then you can look to move your stop loss into profit, and eventually that will hit your take profit. All right. So that is how we look to trade these. Of course, we want more confluence than that, right? You're never going to be looking at just one factor. Like you can't just see a fair value gap and say, I'm going to trade that. It's got to make sense. It's got to be in context. This is at the lows. It's come into a 1 hour fair value gap. You start to get a nice movement to the upside that leaves a fair value gap and price comes into it and goes. All right, some people who want to be very cautious, this is a pretty aggressive trade. All right, and that's because we haven't really done anything. We've just come down, we get a little move back up, but this little guy is starting to tell you something. It's whispering to you that we're going on up. Some people want to see actual market structure change, all right? So that's fine too. You could wait until we start putting in these higher highs and higher lows and finally take out. This is a relatively more substantial looking high. This is just a one candle pullback with a lower low and a lower high. And this one is the same thing. So they're not great places to be looking for a shift in market structure, although they are great looking changes of character. So you could wait for that. And again, you take that high, and so now you start doing the same thing. You start looking for a opportunity to get in on a fair value gap. And here's a fair value gap that's already been hit into. Price then comes down, sweeps this little consolidation zone, moves away, and then surprise, surprise, you're left with a fair value gap right here. That price then comes into relatively quickly after and continues the move up. Okay, so cautious trader and aggressive trader. All right, both are absolutely fine. It depends on your psychological makeup and style. All right, so that's really how we would trade these. Okay, we'll join our Discord group. We do this every day. You'll see the different elements that we put into this. We live trade New York Open pretty much every day except for Wednesdays. You will see us in action pulling this stuff off. What the other thing about fair value gaps is we can make several videos on fair value gaps, but they're also great indicators as to how the market is moving and what to expect. Okay, so one thing that you really want to pay attention with is the respect of the fair value gap. All right, so again, we've got a fair value gap here to the downside, and we're in bearish market structure, right? That's why this is so aggressive, this long entry here. Price comes into the fair value gap and rejects, but you notice that it's not a huge rejection. All right, it's not much of a reaction. And then the next candle opens, does a little pullback, and then comes into the fair value gap. And then we get a little consolidation candle, and then we get a breakaway gap out of this fair value gap here. All right, so this is a bit of a strange looking breakaway gap because you think to yourself it's not really breaking away from anything, but it is breaking away from this fair value gap. All right, so breakaway fair value gap, very rarely does price come back into them. Well, it'll come back into it, trust me, but it doesn't come into it quickly. All right, and then we get the next gap here with a little consolidation, and that is a great place to be looking for a trade right there. So because we have not taken out any real structure here, you know, this is a medium aggression trade, I would say. It's not the best, but we're looking pretty good because now this fair value gap here has been disrespected. So the bearish fair value gap's not being respected, and we've had a bullish fair value gap here be respected. Then we get a breakaway gap, and then a little kind of runaway. Price starts consolidating here, and then eventually it moves. And these are huge moves, all right? They're absolutely massive. This is from the top of the gap to the top of this move is 149 points. It is huge. Um, yep, huge. So now that we see this happening, all right, this breakaway gap here, it starts to tell us that we are seeking out highs to take, okay? So this high is the first thing on your list, right? We come up and we take out that high. Then we consolidate, and then you get another breakaway gap out of this structure here. Okay, in this case, price does come back into it relatively quickly, and this is now mitigated. Price then comes back into it before finally pushing away. And now you leave a small fair value gap here with a pretty deep retracement into it. And then a very nice fair value gap here, which price comes into, pushes away. And then it gets disrespected. But we do not start thinking that this move is over because we've got all of these down here. But it does start giving you an inclination that things might be starting to turn around here. Now, the interesting thing here is that we really don't have any fair value gaps here. You've got this one tiny bearish fair value gap, but if you look at this candle and the retracement into it, it's way more than 50%. And price starts just hitting into it and hitting into it, and it's not really showing it much respect or reaction. So there's no reason to really get antsy about this, all right? There's nothing in terms of fair value gaps that's telling you, yeah, this is over. And then price comes down into this old fair value gap that has now switched from a fair value gap into a support and resistance level. All right, and then the same thing, it just rinses and repeats. Starts ripping, fair value gap. This is a common fair value gap. It doesn't really break out of anything. It doesn't really run away. And price comes into it and continues on its merry way. All right, so that's really how we use these on a daily basis. They're always available, and it doesn't matter what time frame you're looking at. They're great on all time frames, all right? And once you start seeing these big moves up, like this again, fair value gap, it's telling you that we are looking to take this high, all right? Look back, it might be another high, all right? And that's exactly what happens. We come up, we take the highs, and now we're obviously in premium price zones, so we could be looking to counter trade this if it gives us the right opportunities. In this case, on the 15-minute chart, not great. We are creating fair value gaps to the downside, but it doesn't really give us much of an option here. All right. So in this case, what we could do is actually look on the lower time frames and see what we could get out of that. So let's just take a peek here at the 5-minute and see if that helps us out. That's a bad fair value gap, but you see it still holds. So again, this fair value gap, that's a pretty deep retracement into this candle, and it leaves you this very small fair value gap here. Okay, it holds on one attempt, gives you a very nice half-hour trade there. Quick 53 points, very nice. And then price comes back, disrespects it, cleans it out, and then starts moving away and creating more fair value gaps, and just starts really ripping to the downside. So pretty tough to catch these moves. If you go down to the 1 minute chart, it'll probably give you better opportunities, but it can get a little bit harrowing on the 1 minute chart. So be careful with that. So what I would recommend is use a 1 hour time frame, then check it out on the 15-minute chart. Use the 15-minute chart, check it out on the 1 minute or the 3 minute chart. Play around with your times. What you really want to be cautious with is your stop losses. All right. So in Bitcoin, it's a lot safer to be looking, for example, at 1 hour fair value gaps and entering on the 15-minute chart. On the NASDAQ, you're going to find that your stop losses on the 15-minute chart are going to be huge. All right, they're going to be very big. So here, for example, Bitcoin comes down, puts in a low, a higher low, and a higher high, taking out this high, which was the bearish market structure. So we can start to now think about potential longs, and we've got this lovely fair value gap right here. Price comes into the fair value gap. How? Okay, so let's check this out on the 15-minute. And we'll think about adding it, opening a potential trade here. So if we go down on the 15-minute, you see the fair value gap is even bigger. All right, so we could refine this, make it a little bit bigger. We're definitely in discounted zones here, right? So price comes into the fair value gap, and we've even got another fair value gap right underneath it. In fact, it's just one big gap here, right? Because there's no wick here and there's no wick here. So price just kept going up. So we could actually move this fair value gap now to here, which is actually making our target zone quite a bit bigger. So our stop loss might be starting to get quite a bit larger. So if we were looking to trade this from the top of the fair value gap, that's a $415 gap of a 0.62%. So you would adjust your margin accordingly and wait for price to come back. If you wanted to ladder entry in, you could get one position filled here, one position in the 0.5 of the fair value gap, and one position at the bottom, which never gets filled, and price starts moving away. But personally, again, I would wait for a reaction and then look for a reason to get in on a trade. In this case, you've got a very cheeky little move away here, which doesn't really leave you much in terms of fair value gaps, but you do have pretty bullish looking candles here. You're getting wicked down and then moving away, and then finally you get the breakaway fair value gap here, right? And then you get a common fair value gap here. Doesn't really accomplish much. Then you get a common fair value gap here, but that is a very deep retrace. It's looking kind of nasty, but you do have a supply demand zone here and a order block, which we'll get into in the next couple of videos. So there's always reasons that you can be looking for to take advantage of this stuff, all right? But that's generally how you want to play it, is look for the 1 hour fair value gap, get down to the 15-minute chart, modify your idea as price comes into it, look for a reason to get in, all right? Then this is a bit of a tough trade, but pardon me, if you know what you're looking for, it's actually not that bad. So that is going to do it. I hope that was informative. If you have any questions, again, join our Discord. Just throw up questions. Everybody's pretty friendly in there. The next video, we'll be looking at order blocks, and we'll continue this idea. We're just going to keep incorporating everything as we move forward. Fractal structure I will do closer to the end because fractal structure is very aggressive type of market structure, and it can get people in a lot of trouble because a lot of people, for some reason, when they start trading, like being very aggressive, and it's not something that you really want to do when you start. You want to be more patient and uh, and go for more sure things. All right. So what I would recommend is that you look for these on Bitcoin. Look for the 3 bar pattern. Look for them on the Bitcoin futures market. CME gaps. They generally get filled, and then you'll get a move off of them. And this is where you'll see those exhaustion gaps in the futures. All right, and they're not exactly the same. You can see the futures now are at 70,300. Bitcoin is at 69.6, but they're very similar. The movement is very similar. All right, here is our Bitcoin futures chart, daily chart, and we'll look at the daily chart here. So they'll just give you little extra things to think about and to, be safe about. So Bitcoin futures. It's pretty much the exact same thing, right? Look very similar. Then give them a shot on things like Tesla, Nvidia, Google, Apple. Try some Forex pairs. Try your indexes, your NASDAQ, your SPX, your DAX, your Dow Jones. Play around with this stuff as much as you can. And the more you play with it, the easier it becomes, and the more you'll understand how to really use these effectively. All right. So not to go out tomorrow and start using these, but to go out tomorrow and start charting them out, mapping out ideas, think of your premium discount zones, what makes sense, and for goodness sakes, do not be lured in by the crazy movements. All right. For example, you can see here we've got this move down on Tesla, big gap down. All right, so here we have, a huge gap. So this is where price closed, this is where price opened. And these are the kinds of moves that make people very, very emotional. That's a 10%, $22.45 drop. So that's from a Friday to a Monday morning. And people get FOMO'd in with this stuff. This is what will get you to FOMO. So you don't want to be excited when you're trading. You want to be like really not excited. Be really chilled out. So when you see a move like this, it's not something for you to chase, right? Wait for it to show you what's going to happen. Be patient. And then of course price reverses because these big moves at the bottoms where you're coming down to this consolidation zone here, it doesn't make sense to be shorting here. It makes sense to be looking for a long, right? So use these to understand that. All right, now this is a bit different here because you've got a breakaway gap, all right, formed here, and then the next day you get a runaway gap off of the breakaway gap, which is also a gap that breaks out of this zone here that we were in consolidation of. So if you go down on your lower time frames, you can look for a reason to hop in a trade, and this is going to be your target because that's what these fair value gaps are telling you, right? Big gap, big gap. We're looking for highs. All right, down here you've got a big gap, a big gap. We're looking for lows. Price gaps down, takes this low, which is a pretty bad low, I'm not going to lie. But it's just a bit too much, It's just too much. This is too much too, but we're talking about Tesla. So if we look at Tesla, it also has a tendency to really move high when it's putting in bullish market structure. All right, so it's not confirmed 100%, but we've got a low, a swing high, and a swing low that's higher. Okay, so it makes sense that we're gearing up to take out this high here. Who knows? We'll see what happens. we'll see what happens. But yeah, it had its earnings report, wasn't as good as expected, and it's done all this. So could be a trap, could be turning around. We have taken out the liquidity here. That's what the gaps were telling us we were going to do. Uh, so let's see what happens there, all right? Anyhow, again, join our Discord. Be safe, be well. If you have any questions, put them in the comments. If if you have complicated questions, join the Discord. We'll be happy to answer any questions. It's free, and you get lots of great resources and good traders in there. So, hope to see you soon. Have a great one.